Hello and welcome. This is Stocks to Watch. I am Agam Vakil. This is where we take you through three stocks which are buzzing or in the news and take them up with our experts. Today we have with us Rusmik Oza. He is the head of fundamental research at Kotak Securities. Rusmik, good morning and thanks for joining in. But before I go across to Rusmik, let me quickly take a look at the three stocks we want to talk about: Asian Paints, Bajaj Auto, and Metropolis Healthcare. I'll start off with Asian Paints because we've seen muted earnings largely on expected lines, perhaps a decline of 7% in its sales. Its profit also saw a drop around 2% year on year. It's been mixed when it comes to several analysts and their take as far as the earnings concerned, but we all knew that while the months of January and February were strong, March saw a sharp drop. Rusmik, let me get you into this conversation. Good morning to you. How do you see Asian Paints from here on based on the kind of earnings that we see?
Good morning, Agam. Asian Paints is one of the companies which is reporting quite resilient numbers. Okay. In fact, I think this fiscal year also we are not expecting a major impact, but still, nonetheless, I think so. In our estimates, we're building around 20% degrowth on account of COVID, because what has happened is 40% of the revenue still comes from most of the tier 1 and metros where there is certain issue of COVID still going on. But the company has been witnessing very good recovery in the smaller towns. That's what they've been saying. They have the benefit of a lower raw material cost also. For example, in last quarter, the gross margins have gone up by 450 bips, and I think that lower raw material cost benefit will be there in the first half also. So though we expecting very poor numbers or little muted numbers in this fiscal year, the recovery because of the pent-up demand could be very strong in the second half and in the next fiscal year, and the earnings growth or the EPS will be far higher than what we have seen in FY20 in FY22. In case of Asian Paints, the way we do it, we're looking at a DCF-based valuation because PEs are not very relevant in companies like Asian Paints. So based on our DCF price, we get a target of around 1700, and we have a reduced rating on the stock because of the rich valuation, because the upside from here looks quite on the lower side. So at 1700, if you're looking at the implied price to earnings on a June 22 estimate, it comes around 45 times, which is like fair enough. Because as if the company on a forward basis almost close to peak valuations right now, that way. But Asian Paints is one of the bellwethers and the one of the best well generating stocks. So whenever for any reason there is correction in the stock, maybe at that point of time one can look at entering the company.
Which is in focus, and that's Metropolis Healthcare. We understand that the promoters are looking to sell a little over 4% stake, closer to 5% actually, 4.6% to be precise, through a secondary placement offer of shares with the floor price of 1300 rupees a share. And of course, this aggregates to around 304 rupees, rather 304 crores. And the promoter stake, should this secondary placement be successful, will fall to 52% from 56.9%. Now, Rusmik, firstly, I reckon that we can expect a little bit of dip, at least in early morning, as far as Metropolis is concerned, should this secondary placement come through. My question really is that how are you seeing valuations and how are you seeing the prospects of this business at around 1300, 1400 rupees per share for Metropolis Healthcare?
We're extremely positive on the entire healthcare segment, especially diagnostics and laboratory business. In case of Metropolis, particularly, the stock in the last couple of months has rallied a lot. So we have a reduced rating on that stock. Our target price based on DCF is coming to around 1240. Now this DCF captures almost all the growth that's going to come in the future, cash flows to the best extent possible. So we would like to actually wait for the stock to dip. If the stock goes below 1200, then I think so it makes sense for us to look at the company. The business, particularly till mid of March, was doing very well. In fact, in the last quarter, if you see, till March 15, they were growing at 15%. Then because of the COVID, there has been a dip in the business and everything. But this is one company which we expect healthy 30% growth going back in the normal circumstances in future. It's a very good company, operating at almost more than 30% ROC, 30% ROE, almost 30% EBITDA margin. So almost it meets all the checklist, one would look at while investing. Only concern is on the valuation side, because somewhere as compared to some of the other peers, it's trading quite expensive. So that's our only constraint, and we would like to actually wait for the stock to go down. Our fair value remains at 1240 as of now.
Sure. All right. And from there on, we move on to Bajaj Auto. It caught my eye a couple of days ago because it was one of the top gainers, as far as the index is concerned. What really stands out for Bajaj Auto is that it's run up 47% in the last 3 months, in tandem with the auto majors, of course, and two-wheeler market manufacturers have started to gain traction. So we have seen some amount of gains in TVS Motor Company, Hero Motocorp as well. The on auto companies are advancing at this point in time on hopes of some recovery. I know that the current scenario is still very, very weak. But Rasmik, how are you based on Bajaj Auto specifically in this case?
Again, amongst the two-wheelers, we like Bajaj Auto the best as of now. In fact, the two-wheeler space itself is likely to do very well, because whatever commentaries we have heard from managements, there is a preference towards two-wheelers going forward, because people would like to have their own personal transportation, and try and avoid public transportation for at least some time. In this background, and the fact that rural economy is likely to do far better than the urban side, I think two-wheelers stand to benefit. Uniqueness in case of Bajaj Auto is, if you look at the last quarter of the last fiscal year, the export volumes are almost close to domestic volumes right now. And in fact, last year their export business has grown by 10%, when the domestic business has suffered a lot. So it provides a natural hedge to the company, and the exports are also very well diversified to almost around 79 countries they supply. And I think so they're number one and one or two in almost 29, 30 countries where they supply their vehicles. They have recently increased the prices also. I think 2 days back, I was reading that production has gone to almost 80% normal levels. So all this bodes well for Bajaj Auto. I think we are neutral at right now because of the sharp run up. Our target is around 3,000, but it's at a fair valuation. So how we value Bajaj Auto is we value the core business at around 15 times, and take the cash as it is. So I think we get around 15 times 1 year forward valuation, plus around 625 rupees of cash, gives us a target of 3,000. But this is one company where investors should look at, any dips one can look at buying, because on the export side they are doing better. The margins on exports are better, and the three-wheeler business is also not doing bad as of now. So right now everything looks quite good for Bajaj Auto as compared to the peers.
Okay. All right. Well, that's your view of Bajaj Auto. Rasmik, and on that note, we'll leave it at that. Thank you so much for joining us and taking us through your views on the stocks which are in focus today.
Thanks, Adam.